Hi, I am Jeffrey Wernick, and welcome to another episode of Podshoot. I'm happy to welcome Garett Jones as my guest this week. Garett teaches at George Mason University. I would say that George Mason University is one of the few economics programs that I think actually embraces. A model that's close to laissez-faire capitalism and a more libertarian perspective. You know, as someone who I was educated at the University of Chicago in the '70s, so I think Chicago was the center of the universe then. At for that point in time, I don't believe Chicago was any more the center of the universe for that, but certainly in the '70s it was the center of the universe for that. And I think there's a lot of great work being done at George Mason University, and of course named after a great founding father, George Mason, an anti-federalist, someone who warned us about some of the things we're experiencing today. George Mason was one who was concerned that there were not enough protections in the Constitution against potential tyranny and authoritarian government. And you're also affiliated with I would call a free market research center, Mercatus, that has done a lot of great work. And I guess Mercatus produced I don't know what her nickname is. Hester Pierce was at
Yeah,
Mercatus,
Hester.
right? And Hester
She's great.
Pierce is now at she with the SEC.
hmm Yes,
And,
she's an
and
SEC
she kind of
commissioner.
oversees
Yeah.
she's the one most influential in crypto policy at the SEC.
hmm
I forget her name, but she had a nickname for because
Oh,
of
Crypto Mom.
Crypto Mom. Okay, yes,
hmm
Crypto Mom. You've also written some I think excellent books. I read Hive Minds.
Oh, thank you.
I've read 10% less voting or something like that.
10% less
Sorry about
democracy.
that.
Thanks.
Yes. So I found some of your work very interesting, and as I said, I've read your book, so I'm very happy to have you as a guest. Now, in our brief time that I had to get acquainted with each other, prior to this, you told me that one of the classes you're taking, one of the things I did, after I'm someone who was short the market. Not only was I short the markets, I actually wrote a long letter in 2006. I wrote a long letter to someone who was then chairman of the Council of Economic Advisors, who was a friend of mine. He was a professor of mine at Chicago, Edward Lazier. I don't know if you ever knew Ed. And I wrote basically telling him that the financial system, the banking system was broke. I talked about actually a prediction of problems in mortgage markets, and I had done just a back of the envelope calculation that I thought the negative equity in the banking system at that point in time was $3 to $4 trillion,
hmm
and it proved to be a pretty accurate forecast. And I was in the process of selling all my real estate. So I sold almost all my property, prior to 2007, and and then I would ask a lot of my friends who were in the academic world. I said, in previous crises, like Greenspan had made comments saying, well, what did we learn about regulation and capitalism? And so I would ask people, are you now changing the way you teach finance?
hmm
Because maybe there's something wrong with the paradigm that you're teaching. Maybe the problem is not free market economics. Maybe the problem is the way you teach economics and finance, and you've encouraged the wrong models. Like one of the things I had told Lazier at the time, I think a major flaw is that basically all the financial institutions were calculating risk the same way. So if that model is flawed, it creates a systemic problem rather
hmm
than an individual bank problem. But if every bank kind of comes up with its own models and the models are not that correlated, one bank making a mistake might just be unique to that bank or a few bank. But if every bank makes the same mistakes, then basically you have a systemic problem. And if the encouragement is to use the similar models, that model's bad. And then there was a lot of talk about the different types of models that were being used and how flawed they were. So then, as a result of what came as a consequence of the Great Recession, and a point in time where really the whole financial system was pretty was basically insolvent. It would have gone under if the because at that point in time the TED spread, the spread between LIBOR and Treasuries, widened out to 400 basis points, where it had normally been around 30, 20, 35 basis points. So basically, on the margin, banks were financing themselves at a higher cost than the spreads they had in the loans. So that basically the banks, if the financing cost did not come down, the banks had a negative carry every day, and they were losing money every day. So, and they would have eroded their capital pretty quickly, financing themselves at those rates. So the Fed came in, and the government came in and basically guaranteed all the deposits of the financial system, and those that were considered systemically important. Non-financial institutions like the finance arms of General Electric, the financing arms of GM and Ford. I remember at one time, because I bought I don't remember, I bought Ford bonds. Ford commercial paper was trading. I remember the yield over 40%. So clearly Ford was not going to be able to pay 40%, but that was the yield that they were paying. And clearly all these financial arms would have had that were highly leveraged, just when at those type of interest rates, just couldn't afford to carry. So it was clear that the government had when I wrote Ed, I said, basically, you have two choices. This is after the fact. Before the fact, I'd already warned him, but after the fact, I said, you really only have two choices. My preferred choice is not the one you're going to do. My preferred choice is just let him go bankrupt and let the bankruptcy process sort it out. There's a whole bunch of vulture investors, and wouldn't be a bad idea, me being one of them, that would be able to pick up assets, because there'd be a lot of capital available to buy this stuff. Or the second thing you're going to do is you're just going to have to go in and just guarantee all the liabilities of the financial system, and then engage in financial repression, so you can help the banks recover their spreads while you're insuring all their financing costs. And you'll have to do the same for Wall Street as well, which is what they did. They converted, as you recall, all the Wall Street firms into bank holding company, giving them all access to the discount window. So basically, they could borrow, trillions of dollars at no interest expense. So I would ask some people, what have you learned from this crisis? What do you think the failure in the academic models were on how you teach finance? But there's also a second thing that came out of this. What came out of the financial crisis was Bitcoin, right? So if Satoshi had published that paper in 2000, 2001, I don't think anybody would have paid attention to it. But the paper was published in the end of 2008. It was actually published near the bottom of the crisis. When we're trying to figuring out having Bear Stearns go bankrupt, and Merrill Lynch absorbed, and Lehman Brothers going bankrupt, and what was AGR? What was the big insurance company, AIG?
AIG, yes.
Yes. So there was just chaos and turmoil, because nobody really knew who was going to be saved through a bailout and who was going to be let to fail. So it was that policy uncertainty that created a lot of turmoil in the market, and in that emerged Bitcoin. And Bitcoin was irrelevant for a number of years until I guess around 2015, 2016, something like that. So, but this is probably all born out of the same crisis. So how much have textbooks changed? How much have academics rethought, what did they get wrong, and how these areas are taught, as a consequence of of the 2008 financial crisis that had a systemic bankruptcy of the financial system, and emerged what people call, cryptocurrencies.
Well, let me say that, first of all, thanks for having me here. And let me say, I think the biggest mistake that Wall Street made in their models is they placed literally 0% probability on a Japan-style bubble that collapsed, right? As everybody in Wall Street knew, Japan had a huge real estate bubble. It went up. Japan was a modern country, fancy financial markets, and yet nonetheless, they had a massive increase in real estate prices that massively collapsed. Instead, Wall Street models almost exclusively, almost 100% of them, assumed that the worst case scenario for the US housing market in terms of national prices was flattening, maybe a couple percent national decline, right? One reason that one reason it's sound for me to believe this is that Megan McArdle, columnist of the Washington Post, she went and talked to a bunch of people, and they told the Wall Street folks told her that, yeah, we had built models, we had robustness tests to see if it was reasonable to invest in these mortgages. We were ready for a flatlining in prices, but not for a substantial decline. I personally had a nice conversation with a prominent finance professor who himself had run a Wall Street firm that engaged in, mortgage market securities trading. And he told me, he says, our models would have all blown up if we put in an assumption of a 5% nationwide decline in home prices. 5%, right? So basically, the problem with the Wall Street models that led to, big, supposedly sound players investing big in risky mortgages was not that they were using, mathematical equations they didn't understand, fancy calculus, copulas, multivariate, this and that. It's because they believed our grandmothers, our grandparents who told us real estate is the safest form of investment. They couldn't mentally open up the possibility that Japan could happen to us, even with a 10, 20, 15% chance. They really had what I call cognitive home country bias. As you know, but your audience might not, home country bias is this mistake people make where they invest way too much in their own countries and they don't diversify globally. It's like if you work at IBM, it would be like having all of your retirement funds be stock in IBM. So most French people keep disproportionate amount of their stocks in France, right? Americans keep too much in America. It's hard to get people to diversify. Mentally, it's hard for us to diversify as well and to learn lessons from other countries. People for a long time just said, Japan, that's over there. Things are weird over there. They're different. I think better economics takes account of all the knowledge that's out there. And I think one of the lessons that's happened from the financial crisis is that people have done a little better job learning globally, but still the US is the center of all academic discussion. Well, 80% of academic discussion about monetary policy, business cycles, what good papers look like. You're focusing on US experience, US data sets. Still, we should be looking more broadly. I think one reason I and some other people did a little better is because I grew up on the Asian financial crisis. The Asian financial crisis of 1997, my first paper was on that. And that was a case where there were, pretty sound markets. I mean, medium-rich countries that had big run-up in prices, big collapse. And their problem was balance sheets, right? In those cases, those banks had big balance sheet problems. So that got a fair number of academics to study in the 90s and early 2000s the importance of financial institution balance sheets, debt equity ratios, equity percentages as a ratio of assets. And so I think those of us who did better paid attention to, I guess you'd say, stocks versus flows, right? Normally, a lot of business cycle economics is about paying attention to the flow of GDP, the level of prices, sure, the stock of money, but keeping track of balance sheet ratios, proximity to bankruptcy, that was not something that people in academia sweated much over. Fortunately, Ben Bernanke actually did do good research on this, right? I mean, he may not have drawn the precise lessons you and I would like, but he wrote a great paper on net worth and how declines in net worth could endogenously make a recession worse than it would be otherwise. Because if businesses and investors have weaker net worth, they can't lend out as much, right? And so the smart people in the economy usually, according to his story, the smart people in the economy used to have to borrow money from the dumb people, right? And the dumb people know that they can't really trust the smart people. The smart people aren't nice. The smart people are smart, but they're not nice. So you trust the smart people when they have some skin in the game, and you trust the smart people less when they don't have skin in the game. So net worth as a percentage of GDP, net worth as a percentage of financial assets is a good way to make people trustworthy. And that was wiped out when home prices fell. So I think those two sides, that housing markets can be bubblier than we thought, is something that economists appreciate more than they used to, and that net worth matters more than they used to, especially for financial institutions. Those are two big lessons that I think people have taken away. Fortunately, at GMU, even before I got here, I kind of knew about Vernon Smith's work. My colleague, who's now mostly at Chapman, he ran experiments showing that economics experiments showing that you could have rational bubbles in markets even when everyone was perfectly informed.
Right.
We certainly are open to the idea of irrational bubbles, of mass hysterias or whatever. But if even professional traders, he ran some of these experiments with professional traders. And in some of these experiments, even the professional traders, they created bubbles just like anybody else. So
yes,
bubbles,
his classroom experience and the professional experience have not shown significant differences in behavior.
exactly. So this idea that human beings are a bubbly species is something we should take for granted. I believe this for a long time, and I think the financial crisis reinforced that. And so as a result, the financial system and regulators should basically put some kind of bumpers on the system to make it harder for collapsing bubbles to weaken the economy. That's one reason why I think high equity ratios imposed on banks has been something that's turned out to be important and probably works pretty well, even though people try to find ways around it.
Yeah, agreed. Well, the analysis I did really was pretty simple. Going into, well, a couple of things. One is I owned real estate, and so as I was bidding on certain properties, the prices people were paying, I thought, given my models, were absurd. Second thing is, even when banks were coming to lend to me on property real estate I owned, and I did my own internal valuations, I thought my own internal value, the bank's telling me that my property was worth a lot more than I thought it was worth. So I thought I was more rational in the thing. And, a lot of my friends told me I was stupid for not, I did something different than some of my friends. My friends said, well, these are all non-recourse loans. So if you can take equity out, take as much out as you can.
Yep.
And the property defaults don't care. But one of the things I liked to have bragging rights to is I never defaulted on a covenant. I never defaulted on a loan. So
thank you.
to me, that reputation was important to me.
Mm-hmm.
So instead of looking to take more equity out than I thought my property was going, and then be indifferent to giving it to the bank because there's no recourse to me personally, and I'm already richer for the equity I took out of it, so I have no more skin in the game. So instead, I negotiated lower interest rates and longer terms. So I extended my loan and got reduction in interest rates because if a bank is telling me I have a lot of equity in my property, I said I don't want to take the money out. What I want is a better deal from you. So I negotiated, so I extended my term, a lot of my property I owned from like 15 to 20, 25 years. And I got yields, not significantly higher than treasuries because the banks told me I had a lot of equity in my not that I believed it, but they were sure of it. And so I wasn't going to convince them otherwise, but so I was just curious about all my friends telling me they're taking all this equity out, the bank's telling me how much my property's worth, me going in bids and losing these things. So I started taking a closer look at markets, and one of the things I took a look that was easy to get data from is basically if you capitalize the rent people were paying and come up with an imputed home value, home values which we're trading now about 200 twice the imputed value if you capitalize the rental income. So I basically and at that point in time, since the government has always had a policy, or for a long period of time has had a policy of encouraging home ownership, and want to make home ownership cheaper for everyone. So between keeping interest rates too low, allowing people who really have weak balance sheets to buy homes with almost no equity, and even get people to have equity lent to them, so that they had almost no skin in the game, so that basically, home prices were rising a lot. And the best explanation I had was that people were buying, when you buy a home, as you think about it from, as a financial economist would think about it, is, which unfortunately became the game, is, in the past, buying a home meant I was consuming, housing services, but now people were doing two things. They were consuming house services and betting on the future value of the house.
Yeah.
So essentially, what I told Lazier is people are no longer just, when people are now getting a mortgage, they're financing not only the house, they're financing a call option on the appreciation,
Mhm.
on expected appreciation. So I told them all you need to have happen is if the housing value stays the same, for basically the consumption purposes of having a place to live. But all that happens is overnight, the expected appreciation changes, where people will no longer pay a high premium for expected appreciation. Then we'll have a big decline in house prices.
Mhm.
Because right now, and I had a conversation at a conference, a panel that I participated in, a little bit of a discussion and argument with Myron Scholes, because when I asked Myron, because the fact that he's, he along with Fisher Black, the
Nobel.
fathers of option pricing theory,
Yep.
and I was explaining this logic to him, he explained his counter argument was, well, maybe people expecting, rents to rise. But then I said, look, if there are a whole bunch of REITs out there, retail residential REITs, and if you look at market products out there, you don't see those REITs, on residential housing, reflect the fact that
That's good
anyone
test.
believes that rents are going to go up. So show me in the marketplace where you think anyone in the marketplace was forecasting rents to go up. No, people are not forecasting rents. If you look out, people were getting in the game just like in 1999, where a lot of people became day traders during the dot-com bomb. You had taxi drivers and everybody. People were retiring to become day traders because when they had the dot-com boom, a lot of people made a lot of money, and then they gave it all back after. So I think this was the equivalent in the housing market, is that people just decided, I'm going to get in the business of, people with very limited savings were just leveraging up, thinking these house prices, what everybody was talking about, houses are going to go up, it's the best investment, and I would tell people, well, historically, house prices have not outperformed. If you adjust for leverage, they look good, but if you take it for without the leverage that you can create, and there's different ways you can create leverage in other market securities that could replicate leverage returns in housing markets, and you'll make more money doing that. But all people focused on is, I can make a lot of money in housing, and I'm going to get rich quick. So going back to these, rational bubbles, and it's kind of like what Prince said at Citi, I know everything's going to overvalued, but as long as the music's playing, I'm going to keep playing the game and hope I get out before the music stops, which of course he didn't do. So that's the explanation I gave. I gave Lazier.
Let me ask you the question that my colleague Tyler Cowan raises at this point, which is, since then, homes now are back to about the same levels, whether you adjust for GDP or trend growth or rents, compared to where they were before the financial crisis. So basically, home prices today look financially like home prices did back then. What do you think has changed to make this these high home prices sustainable now?
There's more equity than there was in the past. So I think that's one thing that changes. We have seen high rents. I mean, so in many areas, you actually see, if you capitalize in many places, actually now, if you capitalize rents, capitalizing rents are higher than home prices.
Oh, that's great. That's great. Yeah. Okay.
So that's the difference today.
Yeah.
Is that while home prices have gone up, if you capitalize rent values, home ownership now is cheap relative to renting. The problem is that too many homeowners are capital constrained. They in the past, when the government would step in and through agencies to provide people, loans that they could not get in the marketplace, and insure and guarantee them, then then they could go out and speculate. But I think right now the main, if you look at the marketplace has become, and this is what many people are complaining about, is Blackstone and people buying up homes and renting them out, and they're now the landlord. So I did some of that in 2009. I in one marketplace, I had a couple of partners where I had some people I trusted, and I think I was in the business before Blackstone was in the business of going out and buying properties at foreclosure auctions, and leasing them out. The yields were much higher then, and why I exited the game. Blackstone could securitize their portfolio. I exited the game because I told my partners, who were very happy with the yields, let's keep accumulating more. I said, no, I'm getting out, because the only buyer of these properties are the funds. So I'm not selling to a home buyer. I'm selling to a fund that's going to accumulate a portfolio, so they can accumulate a scale. They can go to a bank, and a bank will finance. Blackstone says, I'm Mr. Blackstone, finance my portfolio. Somebody's going to figure it out. If Jeffrey Wernick walks in, people say, I don't give a shit about you. Get the hell out of here. I'm not going to help you finance your stuff. Not that I have a bad reputation, but I don't have a scale. So I don't have the type of scale that would interest, a bank. There's not a good enough relationship, for them to really care about me. So I did a test, where I said, I'm going to sell, 10% or 20% of the portfolio that I'd accumulated, and see who the buyer was. And I told my partners, if any buyer, if one or two buyers are actually homeowner, we'll stay in the game. If everyone who buys it is a fund, and there are only 2 or 3 funds buying, I'm getting out. So of course, everyone was. There were just 2 funds that bought everything I sold, and so then I just took everything else and I sold it. It was the same 2 buyers, that sold that. I mean, I got a nice return because I was an early mover. So the yields in the market, when they entered the market, were much lower than at the time I entered the market. So I was able to get a really nice exit, out of it. But ultimately, many people were, we had a significant damage to people's credit scores, and many people still have not recovered from their credit scores. And given how regulators got, tougher in going through banks, when they audited the banks, and that's another question that I don't know, and I had this conversation. So I had the opportunity of being, a friend of mine was was on the board of a bank that had bought another bank. That other bank got into a formal agreement with the government, because it didn't after the crisis, it didn't have enough capital to cover the bank. So the larger bank that bought it put equity in, but even that was not enough. The OCC came in and said, we need to see that you really have competent people at the bank, and so you have to show us for a period of time that you have competent people at the bank. So one of the board members of the bank that bought it asked me to go in and help get it removed from the formal agreement that had with the OCC. So so I'm meeting with the OCC and I'm meeting with the Fed. It's 2 primary regulators, and I'm going through their review of the loans. Okay, now when they review a loan based upon, okay, do you have a good appraisal? So do you have a good appraisal means show me how you chose your appraisers. I want to see a bunch of appraisers, so you're not heavily relying upon one single appraiser, and show me that you have a legitimate process, so you don't have a corrupt relationship with the appraiser who's making your loans look good. So
it sounds like in that case, the regulators were acting in a mature way. Has that usually been your experience?
I'll tell you what, because in many of the loans, like things, this was a Mexican bank that owned a border bank, in the U.S., in Texas. So they had some loans in Mexico. Okay, so I'll give you an example of a loan. They had an industrial property in the city in the state. I don't know, it's the state of Tamaulipas or in a city called Reynosa. Okay, so this is just on the other side of the border. Okay, you couldn't get anyone from the bank to ever go there because if you sat near the border on the bridge that crossed over, what you hear a lot is gunfire. Okay,
Okay. Yeah.
so
Tough to monitor the quality of the loan then.
so the loan had a bunch of leases that were about to come due. Okay, the tenants had all vacated the property, so there were people paying their loan payments. Because when I came in, I was very aggressive at basically saying, your contract doesn't require you to be there. Your contract just requires I make the space exclusively available for you, and you have to pay. Whether you're there or not is irrelevant to me. Your obligation is not to pay if you decide to stay. Your obligation is to pay for the term of a contract, whether you stay or not. So I was pretty aggressive at litigating people to make sure that they paid, even if they no longer were there. No, that was not my problem. I had to make the space available to them. I did my job. They have to do their job. So none of the tenants were there. Almost all the leases were going to turn over in the next 18 months. And the appraisers came in and assumed that I'd be able to release the property at higher rent.
Okay. Yeah, that's insanity. Yeah.
So I went through them. They told me they never had an experience at a bank like they had at this bank dealing with me, because I would go through the loans and I say, I'm now speaking to you not as an advisor to this bank, trying to help work out a deal. I'm telling you as an American taxpayer on how useless you are. Okay. So it was a conversation I'm having with them. I said, these are all the loans you're telling me are reasonably good loans, and I'm telling you these are horrible loans. Okay. So your rating on these loans are so inflated. Okay. So if you think about why it is that we have a crisis, is when you come in, I said, you should feel like horrible. You should look in the mirror and say, really, what's the utility of my job? If you're not even looking at the assumptions embedded in the appraisals, all you care about is how we hired an appraiser. So, no one, I don't know anyone who would make a business of saying, I'm going to go out and buy property based upon what the appraiser tells me it's worth. So, no real estate person is going to, they know they have to do it. The banks want it. Everybody's got to cover their ass, but at the end of the day, nobody, people don't really believe these numbers. It's a framework for a conversation. That's all it is. It's a framework for a conversation, but that doesn't mean it's a truthful number. It's just a framework in which you can talk about a number, So, when I ask academics and I said, look, here's the experience I had, and so you don't look at your regulatory impact, how that has on the transmission of monetary policy and asset pricing and all that stuff. And none of this stuff is really embedded in models. Because there's a lot of, transaction costs involved and imperfect markets, because these transaction costs are driven by administrative processing, not market pricing, that are disruptive. So again, hence my question, and now we have further disruption because now we have, in a sense of running monetary policy. Question is what is money? Even Milton Friedman never could answer what money is.
Exactly, right? That's why he always kept a few different definitions of money in his pocket.
Yes. I gave a talk in Chicago once where Friedman was there and at a workshop, and so I was criticizing monetary economics. At that point in time, I was more Austrian, much more believer in the work of Hayek and Mises, than a Friedman. But I said, how can you have monetarism when Mr. Monetarist can't even define money? So what do you manage if he, for him, money was once the monetary base. It was M1, it was M2, and then the Fed created this index by a guy who had studied at Chicago, William Barnett, the Visi index.
Met him once long ago. Yeah.
Yes.
Visi, trying to keep track of like the actual value of money, taking into account the opportunity cost and other assets, right?
Right. Exactly. So what do you tell your students today?
Well, actually, I just talked about this last week. I brought in Lucas's version of this. Lucas said, our empirical measures of money are only weak proxies for our theoretical idea of money. The way my colleagues put it in their textbook, Alex and Tyler, is they, rather than worrying about a bunch of official definitions, they say money is readily spendable wealth, right? It's what we'd call liquid, but they're putting it in a freshman textbook. So I think that's the right way to think about it. And once you think about it that way, you realize it's a blurry concept that can never be pinned down exactly. And that's why pure quantity theory, MV equals PY, is going to work very poorly in the short run or comparing across very different institutions, right? So what feels like money to you and me and to most Americans today is very different from what it felt like, what would have felt like money a few decades ago, right? So the fact that
do you have any discussion, like right now you have Trump saying, that he would like to lower treasury costs, and not necessarily by lowering the funds rate will you lower treasury costs. And there was examples in the past, like in the Kennedy administration, where they did the Operation Twist, where they tried to buy up, change the shape of the yield curve.
Yeah,
on the most part, these policies have not been very effective at the government trying to intervene in the markets to set interest rates and to set yield curve, because ultimately, I think the market runs monetary policy. It's not that the monetary policy runs the markets. I think the Fed is more reactive to markets than leading markets on the most part. But there is, but many people could debate, and I like to ask people the question, Trumpers. I said, if you think interest rates should be set, 200 basis points lower, one is, first, explain how you do it. Is it just lowering the funds rate, and you think that will not change anybody's expectations, and the whole yield curve will just have a parallel drop of 200 basis points? So walk me through the transmission mechanism of that. And where did you come up with that number? So like some people could say, well, the Fed might say, I have some number that sort of like mimics to some extent like a Taylor rule. So which I would not manage monetary policy that way, but it's a reasonable, it's a reasonable way of thinking about it. So when you speak about monetary policy in the Fed, do you get into a conversation about how the Fed? I'm for abolishing the Fed. The founders were not a fan of fiat paper money. They were not a fan of having a central bank. Even the first and second banks of the U.S. did not function like the central bank does today. Even Alexander Hamilton did not really support a central bank that functions the way the central bank, functions today. And they wanted a complete separation of money from the state. So, which is why, the dollar was, and at that point in time, I always have to repeat this, the dollar, when people referred to the dollar in the founding, they were not referring to the U.S. dollar. The U.S. dollar was something called a continental, and hence the expression, it's not worth a continental, because the continental was a worthless money. So that was the money that the U.S. issued that nobody placed a value on. That most of the dollars in circulation were the Spanish milled coins, gold or silver coins. So when people talked to Ben about the dollar, they were referring to the Spanish mill dollar, which were these gold or silver coins, and they fixed, and we basically had a fixed exchange rate, of silver and gold, and most deposit receipts were deposit receipts that were linked to people holding things in a silver or gold equivalent, for the first 100 years, more or less of our history. So so this issue of having a central bank and issuing fiat paper money, Madison, one of the main reasons Madison looked to convene the Constitutional Convention was because the states were issuing fiat paper money, and he was appalled by the issuing of fiat paper money. And maybe the greatest writer in that period of time, of revolutionary thinkers, Thomas Paine, who wrote, Common Sense, which was at one point the most widely read pamphlet prior to the American Revolution, also wrote a treatise on money. I don't know if you're familiar with money, which also might have been the best critique of fiat paper money, the regime we have today. So how do you talk about it? So I'm a Bitcoiner. So I was a gold I was a gold person before Bitcoin, and as soon as Bitcoin emerged, I said, the hell with gold. I'm going into Bitcoin. So so I have more than three-quarters of my net worth in Bitcoin.
Oh,
So
congratulations. Way to go.
and I don't sell. I don't only hodl. I hodl and accumulate.
Uh-huh.
So but and I have since the beginning. So I would abolish the Fed and I would abolish legal tender laws.
Uh-huh.
So, do you get into these conversations in the classroom?
Yes, partly because it's George Mason. Our students will be interested in it and can communicate, are interested in talking about it, and they can talk about it themselves. So quite a few of our students back in the early age of Bitcoin invested and bought some, and they, I'm sure some of them don't need to work anymore. It was a popular part of discussion in that 2009, 2013 era at GMU. So yeah, I mean, I most of my class is going to be about the current system as it works, and fiat currency and whatnot. And under a system of fiat currency, that's usually not that convertible. But one of the things about fiat currency is that when there's a huge demand for it, you can print a lot of it really fast. And I think that's one of the lessons that most economists take away from the Great Depression. It's basically a very simple quantity theory type story, which is if velocity collapses really quickly, it's nice to be able to boost M by a lot to counteract that decline of velocity. And it's a lot easier to do that with worthless paper money because the government can just print it for free. Now they do it electronically. So I think that's one of the better arguments for fiat currency, is that in a panic, you can print a lot of it. I don't buy the sort of resource cost of dollars or the electricity processing cost of Bitcoin or anything like that is counting for very much. The thing to notice about Bitcoin that you experience every day is that it's so volatile, right? So it's unlikely that Bitcoin is ever going to work as a means of payment or certainly a unit of account. It could potentially work as a means of payment. It seems like Bitcoin works more like works of art, some sort of stable, somewhat slightly illiquid store of value. And that's part of the reason it's appealing. It's very hard to copy, like a Picasso or like a Rembrandt. Mm-hmm. And it has a value that is of course subjective, because you're always wondering how much someone else will pay for it in the future. But the fact that it's very hard to that it's so far impossible to replicate Bitcoin is this unique. That's the unique contribution of Satoshi to the world financial system, right? The inability to copy it and the ability to transact it securely. Those are huge innovations. It doesn't mean it's money in any sort of modern financial definition, but nonetheless, it created something new under the sun. And I have no way to estimate at all what its long-term value is as a percentage of global GDP. But it's obvious that people would like to hold an electronic form of the equivalent of a great irreplicable artwork.
Yeah, I like the art analogy up to a limit. I would tend to agree to you that one of the criticisms when these ICOs emerge, and some people had invited me to speak at conferences, and I would always criticize the ICOs. I'd criticize the ICOs for numerous reasons. Once, I believe them all to be securities, so mm-hmm. They were not really utility tokens. They didn't meet what the SEC or any reasonable person, I think, would define as a utility token. But the Adam Smith, the intuition of Adam Smith, and probably prior to Adam Smith, is if you're a good store of value, you're not a good form of payment, and if mm-hmm. you're a good form of payment, you're not a good store of value. Mm-hmm. Yet these coins were supposedly issued to be both stores of value and form of payment, and you can't do both well. You can only do one well or the other, but you're not going to be able to do both well, for obvious reasons. If you're a good form of payment, it's because your value is stable. But if your value is stable, then you're not a good speculative asset. Mm-hmm. So it should be self-evident that you can't serve two masters. You have to be one or the other. And most of these projects, when they raise money advertising their speculative value. That's why there's active trading on exchanges. Is people are betting on the price. People not buying these tokens because they're investing in. They want to have the currency because they want to participate inside that network, and they're
Yep.
using it as currency inside that network. No, it's just a speculative, value. A utility token, in my money, a utility token is something like when you go to Vegas and you convert your dollars into
Chips. Yeah.
chips, and then you use chips because you're not going to use dollars in on the table. Nobody wants to carry around $50,000 just to have one chip that represents $50,000. And they're perfectly fungible. As long as you trust the counterparty. The counterparty risk that basically by the time you leave, if you still have any chips remaining, you'll go to the cashier and they'll still be in business and they'll honor that exchange. And no different than like going to an arcade where you go in money and they give you little tokens to put into the games. So those are utility tokens. They're a currency that's used inside that system. And they have a utility on why you want to use that over walking around with money. So that was not what really people were doing. They just were looking to raise money, in a way that was easier than arbitraging, regulatory arbitrage. So
I have a question for you about the value of Bitcoin. So, to an economist or social scientist, or the great value of Bitcoin is actually Satoshi's white paper explaining how to do this. Of course, as you, and perhaps your audience knows, Bitcoin is perfectly copyable. The method of Bitcoin is perfectly copyable, right? And it's been copied many times.
Right.
So
it's open source.
Beg pardon? It's an open source system, right? Perfectly open source system. And so anyone can create their own Bitcoin 2 or Bitcoin 7 that's identical. And exactly. And yet the original Bitcoin has the overwhelming amount of value in the markets, right? It's incredible that the copies never take off. So the idea of Bitcoin is, to me, the power here. And yet it's the concrete instantiation of Bitcoin in the original Satoshi version that people focused on. And it's been even though if you wrote it down as a mathematical model, it'd look like a pure multiple equilibrium model where the coin people think is important is the coin that's important, right? The coin that people think is worth a lot is the one that's worth a lot because they're all perfect substitutes. And yet people stick to Bitcoin. Why do you think that is? Why hasn't been this volatility, massive volatility across the various near perfect replicas of Bitcoin?
I'll give you my explanation. Okay, it's just, and again, it's my speculation. That's
sure.
So,
but you've lived this.
So my speculation is very, very simple. Many people, people I guess refer to him as fake Toshi, Craig Wright. Whether he's fake Toshi or not, I'm not going to opine on that. His writing is quite interesting. He's a smart guy, Craig Wright. I read his book. I've seen videos, his talks. I never met him, but I did meet the guy once who I guess is in jail, Roger Ver. So you had two versions. You had two main forks of Bitcoin, right? You had Bitcoin Cash, which Roger Ver was involved with.
Yep.
With Jihan Wu. I've met Jihan Wu, and he and I were on a panel together. And then Craig Wright when he forked with Bitcoin Satoshi Vision. So Satoshi basically talked about Bitcoin as being a form of payment, is what is kind of like, how, if you read the white paper, would come across saying is that the view Satoshi seems to endorse is Bitcoin as a form of payment. But the argument I give is that when Satoshi paper was published, the whole financial system was bankrupt. Mm-hmm. So the question is what would emerge as a form of payment if the payment system was imploding, because the financial system was imploding. So as a point in time when the financial system was imploding and people thought it could completely implode, and someone puts out this white paper and says, gee, what happens if all the banks fail and the payment system collapses because who curates the payment system are the banks. So what happens if we have a disruption of the payment system because who was the facilitator of the payment system are all bankrupt, and how that disrupts the payment system? Then how do we exchange value, among and between ourselves? So I think that was a compelling argument back then. But then early in 2009, I think the bottom of the stock market was about March, April 2009. And then the market started recovering, and the banking system was rescued, and people got to be more confident that the banking system would be there and continued to function as a payment system. So during that period of time, basically Bitcoin floundered. Okay, some people were mining it, it had gone up a little, had gone down under $1, but for several years it had floundered and done nothing. So but then we had irresponsible financial policy. So then people said, I don't trust the dollar. So what became the story that became the dominant story is, if the dollar collapses, since the whole world is leveraged off the dollar as the reserve currency of the world, and the world is very leveraged, so how do I hedge against, a dollar collapse? And, so where do I look for the best monetary policy out there? And Bitcoin has the best monetary policy out there by far, in my opinion. So where do I think is the best way to store value, not use it as a means of exchange? I still think, in the talks, when I was actively giving talks, I'd say, the best shitcoin is the dollar. So spend your dollars, Gresham's law, spend your dollars, hold on to your Bitcoin. So so I think because of how the financial system got rescued, the utility of Bitcoin for a form of payment has no utility compared to the dollar. The dollar dominates Bitcoin for spending. Okay, so it doesn't make sense to spend the Bitcoin. So what's the utility of Bitcoin? If you look at all forms of money, however you want to define it, and maybe nobody has a good definition of how we define it. Maybe it's just a social construct, and maybe it's just we should accept it as the social construct. And so the question is, which of the social constructs seems to have the best narrative? Then I would say that, says someone who was previously, a believer in gold, that had sort of like a fixed monetary policy that was not subject to manipulation, but the difference, if you take a look at what the attributes are considered what's good money, Bitcoin is more portable than gold. Bitcoin is cheaper to store than gold. Bitcoin is more divisible than gold. Bitcoin is more durable than gold. So if you look at the attributes of saying money, and you people back and say is, okay, we have two competing monies, that basically are independent of any form of manipulation, that kind of have a somewhat predictable monetary policy. Bitcoin's monetary policy is more predictable than gold. And then Bitcoin has all these other attributes. So outside of the history and tradition of gold, if you started from scratch and looked at it from day one and said, here's gold and here's Bitcoin, which looks better? I would think that if most people who had no vested interest in gold, would be buying Bitcoin, not gold, if they all emerged at the same time. What gold has is a long history of track record, that Bitcoin doesn't have, but Bitcoin now has, more than 15 years. So, that's a statistically significant sample. So I think the store of value, because most of the quote whales, the people who are large holders of Bitcoin, they don't move it, they hold it. So they've bet on the store of value bet is their bet. So the other bet being at the form of payment, which I think is a less compelling bet, because I don't think it's a better form of payment than dollars. That is the model of Bitcoin Cash and Bitcoin Satoshi Vision. They tried to build something that would be not a store of value. That's why they tried to change the block size to be able to process faster, and they were basically putting at risk the security of the network to speed up the network. And Bitcoin is taking a priority, saying is, the one thing we're not compromising on is we're not compromising on the security of the network to speed it up. So will Bitcoin ever get fast enough that it'll ever be a good form of payment? I don't know, and I'm skeptical of that. But will Bitcoin be perceived as the best store of value? In a marketplace where almost every other store of value is tied to the financial system, and the financial system might implode because of collapse of too much leverage and too much fiat paper money, and will that basically implode? So the assets that are tied to access to leverage, right? If you take a look, remember asset pricing, it's it's the cash flow against the cost of capital, discounted by the cost of capital. If there's a significant increase in cost of capital, even if the revenue flow doesn't change, then that asset's worth could be significantly worth less. So we might have a significant increase in the cost of capital as we have disruptions in the financial system. And more people might say, well, the best way for me to save money, to hedge myself from all this mess, will be Bitcoin. And Bitcoin is the only of the three that have made that bet, as a store value bet. But that's implicit in the and basically it's evolved organically, because the main whales, again, that's the bet they're making. So, and the model that's been promoted by Craig Wright and Roger Ver and Jihan Wu has been a separate model. They have been pushing payment, and I think that's just a bad story. I don't see, and if you take a look at now, and maybe we should get into what you're doing in stable coins. Stable coins are basically, as a form of payment, are expanding the dollar as a form of payment, because of the highest market valued stable coins are those that are backed by dollars. So they're expanding the influence of the Fed, not reducing it, and enhancing the surveillance of the Fed. That's what I wrote to Cochran after the conversation the two of you had, which I didn't, as I mentioned, I didn't watch it whole, but I wrote him and I said, I don't like stable coins, because I think the government doesn't need to issue a CBDC to have a surveillance currency. All the government has to do is basically encourage other third parties to issue stable coins backed by dollars, and then basically say, I want access to everything. I want to track every wallet. Okay, send me the wallet, and I want to basically study every single wallet. I'm going to put it into my AI models. I just had my meeting with Zuckerberg and and all the AT&T guys, and they're all waiting for all this data. They're all waiting to see what everybody does with their money. And so I'm going to hopefully have a whole bunch of people issue these these stable coins. They're going to be even easier to track than we can track movement in the current financial system. So they'll be more trackable and more traceable, and on an individual level. So that's my concern when people say I don't like CBDCs, but I'm okay with stable coins. For me, I see them from a surveillance perspective as equivalent.
Yeah, I think that's a real possibility that they at least get close to equivalent. And in order to get the Genius Act through Congress, the Republicans basically gave the Democrats a lot of what they wanted in terms of adding extra powers, handing powers to the federal government to have at least the option of surveilling a lot of stablecoin transactions. So, and it remains to be seen what the final regs look like. And this is a battle going on very quietly, as far as I can tell right now. Over here, I live in Washington, D.C., so a lot of that stuff's happening over that way. And it's, a lot of the appeal of stable coins is that they might be an alternative to the rigorous post 9/11 know your customer anti-money laundering frameworks, that it might weaken those rules at least slightly. It remains to be seen what's going to happen, right? A couple of bad actors, a couple of bad events could really change all the politics of this. It does seem that there will be a lot of pressure, at least, to allow some DeFi transactions with stable coins that are not monitored, where there's no KYC, no AML. Now, as Cochran pointed out on our podcast, part of the Blue Chip Dialogues, he says, just because these transactions are made under electronic pseudonyms, that doesn't mean they're anonymous. There are people who are good at tracing this, both open source and government officials. So even under current rules, DeFi transactions can sometimes be, figured out. And it remains to be seen how much KYC AML stuff will be imposed in the stablecoin markets. It's certainly going to happen for people who issue stablecoins. Like if I go right now, if you go to Coinbase and say, I want a bunch of USDC, like they know who I am, they know what my bank is. But then once I transact that on a DeFi network, I can transact that through electronic pseudonyms with other people who are, not KYC, not AML'd. That's the world right now. The question is, will that world where there are at least pockets of semi-anonymous DeFi, will those pockets continue to exist if stablecoins become this massive market? Regulatory arbitrage is everywhere. People have been looking for this for a long time. John Cochran pointed out, he says it's really inconvenient for a lot of good people around the world that the $100 bill is the biggest easy store of wealth you can use for transactions. That's pretty inconvenient. And stable coins are becoming an alternative to that for a lot of good people. Of course, there are bad people who use money all the time, but similarly, people use smartphones for bad things all the time. We don't ban them.
Yeah, I might have done in Mexico I was told, but I don't know whether that's true or not. It was just I was told that I did the first acquisition of a piece of real estate, the house I bought here with USDT with Tether. So
fantastic.
And I had to convince a notary. Here notary publics are important. They give public faith to the transaction. So first I went through the rules of the Banco de Mexico, and basically I saw that since it's not considered money or currency, that I'm not doing a purchase sale agreement. That had to be documented as an exchange of value. So the deal I did with the seller of the house was that we were exchanging value. They were giving me the house, and I was giving them Tether in return for it, which ended up having tax benefits to them.
Good for them.
So it ended up being tax good for them. But at the time, the notary sat down. At first I had to convince the seller to accept the Tether, and I think we built some trust in the process. And also, I think I was paying more for the property than he was hoping to get. So that I think he was willing to take the risk because the premium I was paying. Well, because I never negotiated the price. I just said, I'll buy at your asking price on the one condition that we do this in Tether. So when I sat down with the seller and the notary the day of closing, and the notary was asking me, I became comfortable that we can do this transaction, but I'm kind of curious, why do you want to do this transaction? I said, very simple, okay? I don't want to have to go to a bank branch, speak to a bank manager, and give any explanation on what I'm doing with my money and why I'm doing it, okay? First, it takes time for me to go to the bank, and it's my money, okay?
Yes.
So I think it's a mistake to have somebody custody your money, because once you put it in, you can't say it's mine, give it to me, and that's all I need to tell you. If they're not satisfied with your explanation, they can hold on to what's your property.
And it's not really your money, right? Yeah.
So, and he's going to have. So I don't have to ask anyone permission. Okay. So I don't want to do things that I have to ask permission to use my property. Okay. That's a stupid concept. Okay. Really, why would I ever want to have something that's valuable to me, that's mine, and to get access to it? I don't have 24/7 access to it, okay? And then I have to get permission, because you don't have 24/7, because there are limits on what you can do electronically, right? You can't go to an ATM, and take out $1 million from an ATM, right? You have limitations on what you can wire. Okay. And once you bubble these thresholds, you got to go to somebody who typically has to go to somebody else. So it's not like you walk into a branch and you get to speak right to the manager. You got to go in, you got to pull a number, wait for someone to call. You got to explain to them. Then they bring the manager involved. And so I said, I have to take here. I'm sitting down with you. I'm getting out my mobile phone. I'm passing it to you right now. This is going to take less than 10 minutes. Okay. And he'll have his money, and I don't have to, and he doesn't have to go anywhere, and I don't have to go anywhere. I don't have to ask permission. He doesn't have to ask permission, and he's going to have the value quicker than if I went through the process of doing it through all the permission process.
This is something where the generations younger than us might be better than us on this, right? Because they're so used to being able to get 24/7 access to their money that any form of government regulation that says, no, you got to go talk to somebody and talk to a notary and fill out a bunch of forms, they might just walk away from that and be disgusted by it in a way that most people in our generations would just be like, well, that's just what you got to do. I mean, the idea, you're right. The idea that you have to do a bunch of paperwork in order to get your own money is crazy. Cochran again said something about if you're trying to move more than $10,000, you feel like you have the whole federal government keeping an eye on you, right?
But it's not always holding. It's the fact that you have to ask permission. I mean, that's just philosophically.
Yeah, if it's your property, you should be able to move it permissionlessly.
To ask permission for stuff that's mine. Okay, if it's not mine, then I ask for permission. Okay, but anything mine, why should I go to somebody who's holding what's mine and ask for permission to have access to what's mine?
Yeah,
I mean, just conceptually, why would anybody think that's acceptable? So people, they call it a demand deposit, but as they're not really on demand. They're not really payable on demand.
No, there's a bunch of paperwork saying we might take a few days, and if you want it in cash, we might say no, and all that kind of stuff. Yeah.
So
it's pretty long. Yeah.
Yes. So so how you're now also advising some companies that are rating stablecoin issuers.
Yes, I'm chief economist at Blue Chip. We are a stablecoin rating agency. We give letter grades A+ through F for the economic safety of different stablecoins. And so far, nobody's gotten an A+, but there are a lot of Fs.
So, for anyone who's considering stablecoins or already owns stablecoins, from your experience as being someone who really takes a look at all this stuff and in depth, and says, okay, this is a good stablecoin issuer and why they're a good one, and this is a shitty stablecoin issuer. Why? What advice? What guidance would you give people?
Well, they should put a lot of weight on stablecoins where their assets have been audited by a credible auditor. So if they say they're backed by $1 billion in U.S. Treasuries, you're not just taking their word for it. And second, you should check and see if legally, under the laws of the country where they're set up, their assets are bankruptcy remote. So if their project or some part of their project, some company they're affiliated with goes into bankruptcy, can a bankruptcy judge say, these workers weren't paid for the last 6 months, so we're going to sell a bunch of the stablecoins assets to pay their salaries. So you want bankruptcy remoteness and a credible audit. Those are two things that you really should be looking for. Those are hallmarks to safety and hallmarks, not the whole part, but they're an important part of what help a coin get good ratings under Blue Chip's rating framework.
How much have you? I don't know how intimately you were involved in the quote crypto markets prior to the bankruptcy of Celsius. Have you studied Celsius at all?
No. It's actually one I don't know. I only know by name. Celsius. No, please tell me a little about that.
Oh well. Celsius was. I think at one point in time it claimed to be the largest DeFi platform.
Yeah.
And
they've been gone for over a decade now. That explains why. Yeah.
Yeah. And
they've been gone. Yeah. Excuse me. Last year. Yeah.
Yeah. And they went broke because they really weren't the DeFi platform. I mean, this is the problem. A lot of people use terms that don't accurately describe their business model. So a lot of people that say they're DeFi platforms are not really. Then the question is how would you define decentralized finance? And if you came up with the definition first, then the question is this an accurate description or an abuse, of the term? So like to some extent, I never really liked the referred to the stable coins as being stable coins because for me, when I mean stable, I think the stable money is stable in the sense that it preserves the purchasing power of money, and stable coins don't preserve the purchasing power of money. They just preserve the stability of money with respect to some reference, which is the dollar. And the dollar is not a stable coin because, by definition, it's not a stable coin, because when you announce an inflation target of 2%, you're basically saying I have a plan to debase money, every year.
Yeah.
I have a planned debasement of the money. Mostly any business would not be considered a legitimate business if they give you value and they're telling you, my plan is to make what I'm conveying you today. The moment I get it out of my hand and put it in your hand, I'm proactively working to debase its value the minute I give it to you.
Well, of course, the reason we hold money isn't I hope none of your audience holds currency as an important part of their financial portfolio, right? So, we hold it, like you said, you treat it as a shit coin, you want to spend it. So it's the liquidity services of money, of currency, of checking accounts that's useful. And so I hold just enough of that to keep my stuff going, and the rest in other assets that hopefully earn a better return. So that's the value proposition of the dollar is the ease of use, not that it's earning any great return or even holding its value over time.
I have another question. How much, I've heard even which kind of appalls me, but when I hear like someone like Mark Levin, who was in the a pundit.
I know of him, yeah.
Okay, who was in the Reagan administration, and someone who had professed to have high esteem for Reagan, has now basically said that one of the important things Trump is contributing is a whole new economic paradigm. So I guess basically now Mark Levin thinks Reagan was a very flawed thinker. So and that in economic enlightenment is Trumponomics. So I mean,
Trumponomics.
There is no, you really can't call it completely mercantilism. It's sort of like part mercantilism, part fascism. So when you're now in a classroom where basically you have all these textbooks that promote this economic paradigm, and we see a whole country adopting an economic paradigm that's in conflict with anything that's in any textbook. Okay. How do you have this conversation in the classroom if students want to have a conversation about saying, this is what I'm reading in the textbook, but the real world is telling me is that everything I'm learning in the textbook is garbage because you don't know what you're talking about. I got this president who tells me you're all wrong, and this is the real, economic model. And why aren't you teaching me Trumponomics? So.
Yeah, I mean, I think this is a case where the classics combined with good evidence are really what you go back to. And that's what I've been doing. I mean, I see a lot. Fortunately, economists have been pretty good on this, on social media in particular, sticking up for the basics of the law of comparative advantage, why specialization and exchange is a good idea, why trying to do everything in your own country is actually almost always a bad idea. These kind of classic laws of, basically David Ricardo and all of the subsequent thinking on explaining the merits of something in the direction of laissez-faire trade policy, why those things are wealth creators for the nation that does them. You're not a sucker to let foreigners send you stuff that's cheap. That's not a sucker's bet. That's actually something a prudent household does. So, economists have been right for a long time. It's important to tell, if you're a medical doctor, it doesn't matter how important or rich the person is that's smoking cigarettes. Your job is to say, smoking cigarettes really raises your risk of lung cancer. It's not going to happen for a long time, but it's still really bad. And so, that's my job, is to tell people, maybe you have some other vibes-based reasons, but if you're going to give me something concrete, I can tell you, here's what's very likely to happen over the next 10 or 20 years if you follow down this path of, in particular, just to focus on tariffs. Like, here's why economists have never thought tariffs were a great idea. If somebody wants to say tariffs are the only way for us to close the budget gap and going bankrupt nationally would be really bad, that's a different argument, right? That's not a normal free trade argument. That's saying, like, we need to raise taxes. politicians won't let us raise it on anything else. Defaulting would be bad. That's like a fiscal policy case for tariffs. I'm not crazy about it, but it's at least a discussion you could have that doesn't involve trying to overturn everything that economists have ever thought about trade since David Ricardo.
Yeah. And I think that it's unlikely that Congress would take that approach, that they're going to significantly raise tariffs to fund the deficits.
We'll see what happens if how many of the tariffs get overturned by the courts as being unconstitutionally, presidentially created tax increases, right? We'll see.
Yes.
And then will Congress come back and take some of them? They might take some. They might say, okay, you can raise tariffs on China as long as it's up to this level or whatever. You can imagine some scenario where they gave a bit because they've liked the money that's been coming in this year, so they don't want to give it up.
How do you deal with the fact that, I think one of the reasons why, I describe the U.S. not as a capitalist society. I describe, my word for describing our political economic system, or series of words, I should say, are that the U.S. is a corrupt, crony, corporatist cartel run by kakistocrats. So that's how I describe the United States today and has been for quite a while. Not just related to Trump. This is a description I would have used pre-Trump. So this is not unique to me criticizing Trump. But then I see a poll. I see a poll that Democrats don't like capitalism, and Republicans love capitalism. But the Republicans love capitalism because they love the Trump policy.
They love
the Trump policy is not a capitalist policy. Why are people? Not just yourself. Why isn't it made more clearer that Trump is not a capitalist? Okay. And it should be clear that you can't be a capitalist, And again, it's okay to embrace Trumponomics. It's just not okay to call it capitalism.
This is a question about one of these definition questions, right? One Chicago economist said that we need to save capitalism from the capitalists.
Yes,
exactly.
Zingales
said that.
Zingales and Rajan wrote that book. Yes.
Yeah. And it was Ayn Rand who said she was happy to treat the term capitalism as a word for laissez-faire. The question is, maybe we should have to break that in two, and we should say, no, capitalism is probably a system where capital is powerful, and maybe those capitalists do a lot of rent seeking with their power. So maybe we'll have to change what capitalism is, not in a Marxist direction, but in terms of a rent seeking direction. That maybe capitalism is a system where politically powerful people are people who own capital and they tend to manage it for their own benefit.
Yeah, but how could it be the system of high tariffs?
Yeah, you're right. That's a wealth destroyer, right? It does favor. Yeah, it's probably probably even a wealth destroyer for the insiders, right?
Taking golden shares in company, putting money into Intel, now saying that maybe they'll take ownership positions. So this model doesn't closely resemble. So
it's oligarchical capitalism at best.
So doesn't it
make kakistocracy works fine for that, right?
Yes. Doesn't it make it more difficult to those who are skeptical of capitalism than to have say, well, let's first define this term before we use it? And so if you're talking about what you don't like about capitalism, describe what you're looking at, and maybe what you're criticizing is the mislabeling of something and calling it capitalism, but it isn't really capitalism. So your complaint is not really capitalism. Your complaint is, that this is cartel-like behavior, it's an oligarchy or something else, but it's not really capitalism. So we really all have the same criticism of a flawed model. Only some people are abusing it and using this term capitalism when that's not really what it represents. So I think it's very important that, I think one of the great things that legal contracts do is terms are fairly precisely defined. Yeah. So you go to a contract, first you say, why are we engaged in this business? And then were you going to use a lot of language? So let's agree that every time we use certain terms, we're in agreement on what those terms mean. So we're never arguing over what the meaning of those words are. So that should be a pretty good practice in all communication we have with people.
I might push back on that, because I'd say in the social sciences, sociologists are the equivalent of our lawyers. They spend a lot of time on definitions, and unfortunately, they haven't made as much progress with learning scientific laws. Economists have been lazy in defining things, and I think we've made more progress in terms of learning scientific laws about how society works. So, I'm actually happy that I don't have to sweat definitions every day, and that I can be a little loose and fluid, talking about money, or being able to use capitalism, the term capitalism, to describe actually existing capitalism, rather than a laissez-faire ideal, which is probably better approximated by Victorian Britain, maybe. You're right. It's disappointing that this term, which deserves a better heritage, is now being used to describe the actually existing system in the United States. But I gotta go into a culture war with the words I got. So
that's well said. So I hadn't thought about it from that perspective, and you make a valid argument. For me, I think, like in relationships, I like to have successful relationships, and I think the best way to have successful relationships is to have as little misunderstanding as possible.
Yeah.
And the more you say that there's mutual agreement on what those words mean, the less likely you to have misunderstandings, and the less likely you have misunderstandings, the less likely you're going to have conflict. So, or at least the conflict will not be about the misunderstanding. The conflict will be about the issue that causes the conflict, but it won't be something that'll be, oh, I want to grow this business, and I think we should do it this way or that way, as opposed to just thinking you just can't trust the people because you've had a conversation where you think you don't longer trust the person, not because you think they lied to them, because they used words that they intended it to mean one thing, you interpreted something else, and and that leads to a misunderstanding that reduces trust. And once you debase trust, I think that that's the most valuable currency of all, is trust.
It is.
So that's the framework for us interacting with people, whether we know them or not, is if you can rely upon people to keep their word and honor their contracts, then we live in a much more seamless, frictionless world,
Yes.
and with much better outcomes, for all of us. So how is George Mason's been one of the schools targeted by Trump, hasn't it been? You followed
Yes.
that at all, being a professor, as far as
Yes, of course. Yes, it made the
president?
news. The Washington Post had a profile on our university president last week. I don't keep up with it that much. I know the headlines and I know what's happened. The university did push in a very important way for DEI-driven hiring over the last 5 years, but even before that. And lawyers will have to figure out whether those policies were within the law or not. And I'm happy to watch that discussion going on. I do think that I'm glad to see that a lot of universities have moved away from DEI-driven hiring, and especially from requiring diversity statements for academic employment. I think schools should just do the best they can in their own flawed ways to hire the smartest people they can. And moves away from that are probably going to debase the value of what universities have to offer humanity. So,
well, I think that, here again, it's a definitional term of what do you mean by, inclusion is if you have a whole bunch of people together, you hope they're inclusive. So, you'd rather inclusion rather than exclusion. So, we have some work done, like on the wisdom of crowds, that show, if you get in a room, you're likely to get more wisdom out of a group that has diverse backgrounds than everyone that has the same
it's true. Yeah.
who will think the same way. And that's when a football team, when a team, anything that operates as a team, they don't always look for the best athlete. So,
They want
they
the
look,
person who's going to be the best contribution to that particular team.
so,
Yep.
I don't think it's, so when you sit back and say, what does it really mean? Some level, we do decide that some level of diversity has a rational basis for it.
Mm-hmm.
At some level of diversity
Exactly.
produces a better
Definitely
outcome.
true. But what's happened to universities definitely over the last decade, as many academics can say privately and more saying publicly, is that while I've never been in one of these conversations, I've heard second and third hand that it's very common for a dean or a provost to just come to a department and say, this line is for a diverse candidate, and by diverse, we mean X or Y. And that's really what we want. And so nobody will ever write that down. It has to be something that's only said verbally. But that's coming in as an imposition from the outside without saying, well, make sure you find a diverse person as long as that person is making your team as good as possible. It's this slot is for a person of group X, and that should be the strong presumption for how you fill this slot. This happens a lot in academia. I've never heard these words said in my own presence by a person without authority, but I've heard it secondhand many times.
Well, that's a sad, at a university that should be teaching some level of ethics. The part of the goal of a university is to create good citizens. And people to behave that way is really, I find repulsive. When I started my first business, I was 24 years old and dumb, and unfortunately I had very wise partners, and I was smart enough to at least listen to everything they told me, and one of my partners would always tell me, he says, whatever you say, be prepared to put down in writing.
Exactly.
Don't ever say anything that you're not prepared to also put in
I
writing.
agree. Yeah.
So he said, and don't trust anyone that will not put down in writing what they say. So that was one of the things that he told me that I've always paid attention to. And even in and then when he told me, if you're in negotiations and when somebody says to you, don't you trust me? You never want to debate whether you trust somebody or don't trust me. He told me, just tell them, I trust you. I just don't trust your immortality. So, so now I kind of expanded on it. So if I'm in a negotiation and someone doesn't really want to put something in writing and wants it to be a test of, do I trust that person, not trusting, then basically I tell what my partner told me, but I expanded it. And I basically like to say, I said, look, other people are not in the room. Something might happen to you or something might happen to me. So one day the people reviewing this document didn't sit in the room. It might be your kid. And if your kid is sitting in the room, why do you want to leave that kid with a potential lawsuit? Because there were things that were said in this room that are not in this document, where you and I had these expectations, but the document's not clear, and we're handing over potential litigation to you. You might be handing it to your kid, and I might be handing it to my kid. So nobody ever argued with that, So that ended whether they really wanted to put in writing or not. Nobody ever had
a way to get around the problem. Yeah,
nobody ever had a good
around an awkward moment. That. I mean, it is true though that in politics, ever since Watergate, politicians, presidents are sure not to keep any recording devices, right? They don't record stuff, and a lot of decisions are just made verbally, without the discussions being recorded. And when I was on Capitol Hill, one of the pieces of gossip, one of the pieces of sort of oral tradition, a long time ago, I worked there, more than 20 years ago now. It was if you're gonna don't write anything down you wouldn't want to see in all caps in the Washington Post. And the story was that if you're going to say something controversial, pick up a phone. And that's part of the reason people got a lot in trouble with texting in the last 10 years, right? People text a lot of things they see as a very informal piece of information. And then it can be subpoenaed. It can be quite easily. There's some things in politics. There's some gossipy things that you want to keep as some hot-headed language that we don't need to see written down, and trying to figure out the blurry line between that and coming to agreements that should be clear and spoken and worth being written down. That kind of blurry line, I think, is kind of an important one for society. Like, it is unfortunate that a lot of the great moments, a lot of the great decisions in life are now not being recorded at all because people are afraid how it'll be reported second or third hand if it's taken out of context.
Yeah, I had I had invested in one business. I ended up in the beginning. I invested, and it's one of the few times in my life that I invested as a non-control investor. And so before I invested, I asked to meet who the board members were. So it had what seemingly looked like a reputable board. And I had warned them. I said, I've never really been a passive investor in something. I'm going to take a risk being a passive investor in this. So I accepted. I was about to fund, and they made a decision. There was an important decision that they made. They made a decision, and I had not yet signed the final documents. And I said, "Explain to me, this is stupid what you're doing." So I want to understand your thought process, and I want to understand the thought processes of the board. Well, we have a board that's kind of passive. So I said, well, now I'm changing my mind. If you want my money, I'm going on the board. So so I said, so think carefully. Don't give me an answer now. I'm not an easy person to get along with. So and I've made that clear from our first conversation that I'm not an easy person. So but you didn't have to care much because I was not going to have a voice in the governance. Now I'm telling you, I want a voice in the governance if you want my money. So don't say yes. Think about it. So you better be sure that you understand you're getting a package. You're getting me as a board member, and an investor. And they came back and said, okay, do it. I said, you really sure? I'm not really sure. So I did it. And this was so they had regular meetings of the board of the board. There began to be hostility between me and the management team and most of the board members, because most of the board members let the management team do whatever it wanted. And there were things that the management team were doing that I was strongly against, that I was very outspoken about. And on numerous cases was able to convince all the independent board members to side with me. So finally, management thought I was, they wanted to get rid of me. So they were looking to raise capital, and they thought they could raise enough capital to get rid of me. And I wanted out. So go back to this is transparency. So I said, you're busy raising money. Right now we have board meetings, but there's no minutes to the board meeting.
Mm-hmm.
I have the right, because of my ownership interest, I have a right to have recorded minutes, okay, to the board meeting. Okay? So now there's transparency, so any investor coming in can see how the board operates. So I said, you got to think twice about how successful you'll be raising money with the board meetings we have that we have to have, and with me controlling the minutes to the board meeting, because I'm going to have a notary in here, and I'm going to actually have a transcription of the entire conversation. So just by promoting that level of transparency, because they knew really that if their conversation existed on the type of things that the issue I raised, because I was raising substantive issues, they knew just by having that level of transparency, no other investor would have come in. Mm-hmm. So they basically said, okay, we got to get rid of this guy because we need money in, so, and I was reasonable on the way out. I said, basically, whatever, I'll take a discount from the rate that other person comes on. So I don't want to be like extracting green mail, so I'll get out on a little worse terms than the valuation coming in, but everybody will be happy. I'll make a nice profit, and we won't be in each other's lives. But going back to this comment about the fact is how much different your behavior is if it's documented versus if it's not documented. That our behavior is, if somebody's looking and somebody's not looking, how we should behave. I think we live in a better world if people behave the same way, whether somebody was looking or not looking. But your point is very valid. The more you're subject to discovery, the more you're trying to have conversations in a way that's not discoverable. And the question is, does that produce a worse outcome? And I think that's a very interesting question. So I think the way you framed it is, I find really. So I hadn't thought about it the way you framed it, and I think now I will give more consideration to that. So that's a very good point. I'd like to. You've been very generous with your time. I always like to have my speaker. Maybe the things that I should have asked that you wished I would have asked that you'd like to talk about. And so you've been very gracious, and so the floor is yours to want to tell people, what do you want people to know about you, and what are the thoughts that you'd like to convey that I didn't get to give you an opportunity to do so.
No, you've been asking great questions, and I have learned an enormous amount here. So thanks for having me. I guess the thing I would close by, I just tell a little bit of my intellectual biography, because I think it might be of value to others. I started off studying history, and I love studying history because as a young person, I wanted to know where facts came from. And then after I learned about where facts came from, I needed to find out what caused what. And I tried out a few different social sciences, and ultimately through all that, I found that economists were really the best at thinking about cause and effect. They stuck to their knitting, so they only addressed questions that could be answered to some extent. A lot of people take on questions that are too big to be answered. Economists often, by thinking smaller, can make more progress. And that little bit of sticking to your knitting professionally has, I think, really helped economists a lot for settling a lot of life's big puzzles. I'm really lucky that I had a chance to study other things and come to economics when I was a little older. I started my PhD program at 25. And from then on, that mix of thinking about the world in a sort of clinical way has helped me, I think, make more progress on addressing some of life's big questions. It's great to read history, but when you're trying to learn cause and effect, you need this economist way of thinking about ceteris paribus, other things equal. What would have happened otherwise? That's a really powerful tool, and I hope more people can get more practice with it.
If you allow me one more question.
Sure.
As you said, I think, and maybe you'll agree with this, I think, and as in a way of just promoting George Mason University, at least the economics department, that I think, like back when I was a student at the University of Chicago, I thought there was something unique about studying economics at the University of Chicago back then.
Yes,
I think the academic experience for people interested in studying economics, the experience they'll get at George Mason is pretty unique.
It absolutely is.
Why don't you describe why, if you want to spend a few minutes promoting not only
Yes, I'm
George
glad to talk
Mason
about my department. Yes,
what makes it unique?
Yeah, what makes it unique is there are two different ways of looking at it. One way is that we are a unique combination of what you might call free market economics, basically Chicago-style economics from the 1970s, a little bit of UCLA School of Economics, with a public choice. So, the free market side of our thought, that Chicago school that basically emphasizes how spontaneous order can create value in unexpected ways, how markets don't like to leave dollar bills on the sidewalk, they get picked up. That shows you the benefits of markets. Public choice gives you this sort of all-embracing critique of government. Not that you think government is always bad or we should get rid of all of it. There are people in my department who are anarchists. But public choice makes you skeptical of government in a useful scientific way. And our economic way of thought, heavily informed by old 1970s era, good old Chicago School of Economics, helps us see the wisdom of markets. Our students do math and equations. They can do a supply and demand curve. They also read Adam Smith. They also read David Hume. All economists learn something called the Coase theorem. Economists at George Mason and our students actually read Coase's papers, which no one else does. So our economists definitely come from the James Buchanan political economy tradition, where there is a welcome blurry line between economics, philosophy, broader social thought. And so if you want to learn about economics through a blend of, by seeing it as part of the great received body of wisdom of humanity, a body of wisdom that's still being built, rather than just a bunch of equations and a way to make money on Wall Street, George Mason is a fantastic place to study it.
So for someone who wants to understand, who wants to understand how an economist thinks, how economists frames things, what's unique about the perspective of how economists think about problems, what would be 3, 4, 5 books that you would suggest people who are, novices but want to want to be able to read something that
Yeah.
there's a lot that they could learn from. What would be those? What would be your suggested reading list?
I would say Milton Friedman's Capitalism and Freedom still comes to the top of my list. It's so well written. It it argues for the link between free market economics and personal freedoms in society. It's sort of a classic of broad libertarian thought. A second one I would think of is my colleague Tyler Cowen's book that's in praise of big business. That's a fantastic book for thinking about, why big business, warts and all, actually solves a lot of social problems that we think are often created by big business. If I had to pick a third one, I'd pick something by Thomas Sowell, either perhaps Knowledge and Decisions or Basic Economics. I know that those two books have had a transformative effect on a lot of people of all ages, and just helping people realize that these sort of very intuitive but abstract rules of thinking are super powerful. The best ideas in economics are parables, right? And as parables, they should be repurposed and reused time and time again. I'd say all three of these authors, Tyler Cowen, Milton Friedman, Thomas Sowell, all thought of economics as a sort of set of parables that get used as part of a grand liberal arts tradition. Not something separate from the liberal arts, but something that is a true liberal art and worthy to be included with all the others.
Well, thank you so much. I think three great choices. And Garett, it's really great to get to know you. And
great talking to you too. You too, Jeffrey.
Very much.
Yeah, this has been fantastic.
I hope we can keep in touch. Because I
love to.
like what I've read. I think almost every book you read. 3 books I've read. So I don't know.
Oh, thank you so much.
So have a great day. And again, thank you so much.
Thanks a lot. Take care. Bye.
Bye.